there are larger orders that are being done by more sophisticated investors. And I use the term sophisticated carefully. It's not that they're smarter than the average person. It's just that they're perhaps paying a little bit more attention to their finances and have accumulated a little bit more than the masses. But in general, I would say it's eerily quiet. And it's interesting because we hear all of the issues with tightening on the LBMA or on the COMEX, or 55 million ounces delivered off of COMEX and silver in the month of December. All of these things anecdotal that are on the wholesale side, up a few steps above up the ladder, are disconnected from the reality here in the United States retail. And I would say that a lot of it has to do with the euphoria surrounding, the Trump win, and rightfully so on many levels. We've lived through what is considered bizarro world, and to get our culture back is a big thing. To get normal back in order is a big thing. And of course, he's being touted as the crypto president. And so there's been a lot of, I think you can say, attention moved from precious metals into other areas. And what I find most interesting about this, I've always been a big fan of misdirection. The art of war. It's pervasive. It's used everywhere, especially at the highest levels. And as the public has been misdirected for really almost a year, if we're being honest, into things like Nvidia, Bitcoin, and Apple, and cryptocurrencies in general, XRP, and all of these meme coins that are making people fortunes, and moving away from precious metals, we see the central bankers doubling down on their efforts, doubling down over the last 2 months of the year, twice what the 12-month moving average is. China and Saudi Arabia doing all they can to covertly, privately, although they've been caught twice now, accumulating gold and listing far less than they're actually buying. In other words, the biggest money in the world, the central bankers who know the playbook, the biggest money in the world who's draining the exchanges off of COMEX and the LBMA, the biggest money in the world that is creating shortages in industrial grade bars, are ahead of the curve, where the retail consumer is again being misdirected largely into areas that you could argue on many levels are overvalued and are oversold and or overpurchased, overbought. And I don't know. It's an interesting dichotomy, Andrew, for sure it is, and one that I think if anyone was saying that business in this industry is really brisk, they're not really quite being honest. I couldn't agree more, and talk about how they're doing it. And you look at what's going on right now, like, for example, on the LBMA, and the LBMA numbers are so out of whack. It's crazy. They have pretty darn close to $4 billion of London cash spot silver claims with total vault holdings of about 850 million ounces. So you're talking, and there are people there that are saying they're trading upwards ends of 2.9 billion ounces of silver per day, which is 3.5 times annual global mine supply. I don't have the exact numbers in gold. I think they're trading roughly 2.5 times annual global mine supply in gold. And
the financial landscape is undergoing a seismic shift, one that the majority of retail investors are either unaware of or actively choosing to ignore. The institutions, the central banks, the sovereign wealth funds, they are all doubling down on their gold and silver acquisitions, while the average retail investor is being misdirected towards speculative assets. The fundamental question is, why? If we examine the global economic and geopolitical shifts, it becomes clear that precious metals are no longer just a hedge against inflation, but rather a necessity in a world where fiat currencies are being debased at an unprecedented rate. The disconnect between the wholesale and retail markets for precious metals has never been more apparent. While institutional players are accumulating physical gold and silver at record levels, retail demand remains eerily quiet. This paradox is driven by misdirection. The public's attention has been funneled toward assets like cryptocurrencies, meme stocks, and AI-driven tech stocks like Nvidia and Apple. In contrast, central banks are aggressively increasing their reserves, with the last 2 months of reported acquisitions exceeding double the 12-month moving average. Countries like China and Saudi Arabia have been caught underreporting their actual gold purchases, further obfuscating the true scale of global gold accumulation. One of the biggest factors driving this shift is the erosion of trust in the US dollar and Western financial institutions. The BRICS nations, led by China and Russia, have systematically distanced themselves from dollar-denominated trade and have developed parallel financial systems to bypass Western control. The LBMA, London Bullion Market Association, and COMEX, Commodity Exchange, are now under siege as more nations move to take physical delivery of gold and silver, a process that is rapidly depleting available inventories. In December alone, 55 million ounces of silver were delivered off of COMEX, a staggering number that suggests a growing trend of investors preferring physical metal over paper contracts. The West has long manipulated gold and silver prices through leveraged paper markets, where multiple claims exist for each physical ounce. This system works as long as participants trust that they can redeem their claims for actual metal. However, sophisticated players, particularly in the BRICS nations, have figured out how to exploit this system. They are leveraging paper short positions to drive prices lower, allowing them to buy up physical gold and silver at artificially depressed prices. This strategy is not new. It was used during the London gold pool of the 1960s to suppress gold prices until the system ultimately collapsed. Unlike previous decades, where the West could count on developing nations to blindly follow their financial systems, we are now witnessing a shift in power. China, for instance, has become a net importer of silver, purchasing massive amounts of doré bars directly from miners in South America. This move bypasses traditional price-setting mechanisms, allowing China to accumulate metal without significantly affecting market prices. At the same time, Saudi Arabia has been exposed for failing to report gold imports to the IMF, further indicating that major players are deliberately hiding their true accumulation strategies. As a result, we are approaching an inflection point where the artificial suppression of gold and silver prices can no longer be sustained. When that moment arrives, the revaluation of these metals will be dramatic. Investors who have relied on ETFs and other paper-based gold investments will find themselves holding worthless contracts, while those who own physical metal will see their wealth preserved and multiplied. The writing is on the wall, yet most Western investors continue to chase speculative bubbles, oblivious to the looming reset in global finance.
And I think what changes things now is that the big money across the globe, in particular the Southern Hemisphere, the BRICS, they understand what we're doing and they're using it against us. We saw 55 or 45 million ounces delivered off of COMEX in December. There was an interesting comment by the gentleman who is working with the BRICS Grain Exchange, and I would draw a parallel to the precious metals exchange. Rob talked about this on Danny's Capital Cosm show about the exchanges in Brazil, in Dubai, in Russia, in Moscow, in Shanghai, and how they will build a BRICS gold exchange. But listen to the comment the gentleman said about the grain exchange. He says, we produce more grain and consume more grain than the folks do in the West, yet we can't control the prices. It's controlled on COMEX, but with the development of the grain exchange, that will change. They know what we're doing, and they're not bitching about it, probably even adding to these short positions with paper in order to drain the exchanges slowly and methodically, do the exchange for physical off of other exchanges. Rob talked about that in that interview with Danny. He said, look, they can buy and take stuff off of other exchanges, but it doesn't disrupt the price the way it does when it's taken off COMEX, which is the price setting mechanism. You see China going around the world and buying doré and concentrate. 75% of all their industrial silver is now concentrate. They're buying it directly from the miners, disintermediating the marketplace. And this comes from the second largest producer of silver in the world. I said that to David Morgan. He says, well, they're actually the first. That's what they told me. Well, it doesn't matter. It's semantics, first or second, but yet and now net importers instead of net exporters, flying around the world, buying concentrate and doré directly from the miners, which doesn't affect the price, or it's very opaque as to how much they're getting, and virtually no effect on the price. They're pulling out all of the stops, knowing that we're doing this. And the only reason they're not bitching is because they're the ones that are accumulating it. And that's really the key to all this. We're being played by it, and we're being played by our own stupidity. And, Rob has always talked about the London gold pool and Craig is the one who's always talked about the London gold pool. But if you go back that far, And you go back that far, the LBMA is 140 years old and the COMEX since 1974, all the way until just maybe a decade ago, all of these countries were third world. They weren't challenging or standing for delivery. Nobody did. But now they're sophisticated, they're coordinated, and they're motivated, and they're doing it just fast enough so that we can see it, public doesn't see it, and they're doing it not too fast to disrupt the apple cart. But I think the key to all of this is seeing the deliveries and the lengths. Look at Saudi Arabia and China hiding how much they're buying, not reporting it to the IMF. If the PBOC buys it, it has to be reported. But if the PLA, the People's Liberation Army, buys it, it doesn't. Remember, they're buying all the Doré. If it's not 995 pure, it doesn't have to get reported to the IMF. Look at Saudi Arabia. Oops, sorry, we didn't report it. You got caught on the import-export numbers. All of these countries are doing all they can to exploit the delivery mechanism and buy it around the globe at these stupid fugazi prices that we continue to portray to support the illusion, the strength of our Western system and of our bond markets, and it is coming to an end. And that's why I named my podcast Little by Little, because it refers to the logarithmic decay, little by little by little by little, and bang, all at once. And where are we in the all at once? Where are we on this chain? They know what we're doing. If they know what we're doing with grain, they know what we're doing with precious metals, and they're using it against us. And it too will change.
As we move further into 2025, the conversation around gold and silver is no longer just about their historical store of value. It's about survival in an increasingly unstable financial system. The cracks in the global economic structure are becoming more visible by the day, with debt levels spiraling out of control, inflationary pressures persisting despite central bank interventions, and trust in fiat currencies eroding faster than ever. The actions of central banks, particularly those in emerging markets and BRICS nations, reveal an accelerating trend of gold accumulation, signaling a global shift away from reliance on the US dollar as the primary reserve currency. What's fascinating is that while the mainstream financial media continues to downplay this shift, investors who are paying attention can see the writing on the wall. For years, the West has underestimated the determination of BRICS countries to establish a parallel financial system that isn't subject to the weaponization of the dollar or SWIFT-based sanctions. When the Bank for International Settlements, BIS, pulled out of the BRICS cross-border payment system at the last minute, it was a clear attempt to stall their progress. However, rather than discouraging these nations, it only solidified their resolve. BRICS is now advancing with a system that operates independently of Western financial infrastructure, using gold and local currencies for settlement. Saudi Arabia, China, and Russia have been particularly aggressive in securing their gold reserves, often in ways that bypass traditional tracking mechanisms. Import-export data has revealed significant discrepancies in reported gold purchases, suggesting that China, for instance, has been acquiring gold at levels far higher than officially acknowledged. This secrecy surrounding gold purchases isn't just a matter of preference, it's strategic. The more gold a nation holds without announcing it, the greater its leverage when a financial reset occurs. When the dust settles, those with substantial reserves of real money, gold, will hold a commanding position in the new economic order. The recent revelation that China's actual gold imports could be 10 times higher than reported is staggering. Similarly, Saudi Arabia was caught underreporting its gold acquisitions, and only when trade data exposed the discrepancy did they acknowledge their holdings. This covert accumulation suggests that these nations are preparing for a significant monetary shift, one that could see gold officially reintroduced as a key pillar of global finance. But it's not just nations accumulating gold. Central banks across the world are doubling down on their purchases. Over the past 2 years, we've seen record-breaking gold acquisition by central banks, with purchases often exceeding the previous 12-month moving average by double or more. The trend is clear. Central banks see gold as the ultimate hedge against the economic instability that lies ahead. Meanwhile, Western investors, conditioned by decades of financial engineering and stock market euphoria, remain largely blind to this shift. The mainstream narrative keeps pushing the idea that the stock market is the ultimate wealth-generating machine. But history tells a different story. Every major economic upheaval in modern history has been preceded by excessive speculation in equities and a failure to recognize the protective role of tangible assets like gold and silver. As we enter 2025, the financial markets are behaving in ways that should concern any serious investor. The bond market, which has historically been considered a safe haven, is now facing severe turmoil. With long-term Treasury yields pushing higher despite Federal Reserve rate cuts, it's clear that investors are beginning to lose confidence in U.S. debt. This is a major red flag. The fact that bond yields are rising while the Fed is cutting rates contradicts traditional market behavior and signals that inflation is far from under control. Higher bond yields mean higher borrowing costs across the board, which will only exacerbate the debt crisis. The U.S. government is already running record deficits, and with interest payments on the national debt exceeding $1 trillion annually, the only options left are aggressive money printing or outright default. Neither scenario bodes well for the dollar. One of the most revealing signs of financial distress is the surge in gold repatriation. Nations are increasingly demanding their gold be physically stored within their own borders rather than in Western vaults. Germany led the charge in recent years, repatriating significant portions of its gold reserves from the U.S. and France. More recently, Poland, Hungary, and even Turkey have followed suit, securing their gold within national borders to prevent the possibility of asset freezes or confiscation in times of geopolitical tension. This movement underscores a growing realization among sovereign nations that trust in the existing financial system is eroding. When countries begin hoarding gold within their own vaults, it's not because they plan to sell, it's because they anticipate a future where gold will play a central role in the global monetary system once again. Meanwhile, retail investors in the West remain largely disconnected from these shifts, fixated on the short-term movements of the stock market. While gold and silver prices have seen significant gains, they remain severely undervalued relative to the broader economic picture. The gold to S&P 500 ratio, for instance, still indicates that gold is trading at a discount compared to previous inflationary cycles. If history is any guide, we are in the early innings of a gold bull market that could see prices surge exponentially in the years ahead. The last time we witnessed a comparable macroeconomic environment, excessive money printing, high inflation, and geopolitical instability was the 1970s. During that decade, gold rose from $35 an ounce to $850, a 24-fold increase. If we were to see a similar move in today's terms, gold could easily surpass $50,000 per ounce. While that might sound extreme, consider that the fundamental economic conditions we face today are arguably worse than they were in the 1970s. Silver, often considered gold's volatile cousin, presents an even more compelling opportunity. The gold-to-silver ratio remains at historically high levels, hovering around 80-1. Historically, this ratio has tended to revert to around 16-1 during periods of monetary crisis. If gold were to rise to $10,000 per ounce, a conservative estimate given the current trajectory, silver could easily exceed $600 per ounce. The industrial demand for silver further amplifies this bullish case. Unlike gold, which is primarily a monetary metal, silver has substantial industrial applications, particularly in green energy technologies like solar panels and electric vehicles. With supply constraints mounting due to declining mine output, the silver market could experience a supply shock that sends prices soaring. For those still skeptical about gold and silver's role in the coming financial transition, consider the actions of those with the most to lose. The world's largest banks, which for years have manipulated the precious metals markets to suppress prices, are now among the biggest buyers. J.P. Morgan Chase, which has been fined multiple times for precious metals market manipulation, has quietly amassed one of the largest physical silver hoards in history. Why would a bank that has spent years manipulating prices downward suddenly become a major accumulator of physical silver? The answer is clear. They know what's coming. Even the International Monetary Fund, IMF, and the Bank for International Settlements, BIS, have subtly hinted at gold's growing role in the financial system. In 2023, the IMF released a report suggesting that gold's function as a reserve asset was far from obsolete, while the BIS reclassified gold as a Tier 1 asset, placing it on par with cash and U.S. treasuries. These moves indicate that the financial elite are positioning themselves for a future where gold is once again central to the monetary system. As we move deeper into 2025, the key takeaway is that the global financial system is undergoing a seismic shift. one that is not being advertised to the average investor. While mainstream media focuses on stock market highs and cryptocurrency speculation, the real power players are quietly repositioning themselves into tangible assets that have stood the test of time. Gold and silver have preserved wealth for thousands of years, surviving wars, economic collapses, and currency devaluations. To ignore their importance today is to ignore the lessons of history. In conclusion, the message is clear. Gold and silver are not just hedges against inflation. They are lifeboats in a sea of economic uncertainty. The actions of central banks, sovereign nations, and even major financial institutions confirm that a monetary reset is on the horizon. Whether it happens in the next year or the next decade, the trend is undeniable. Those who recognize it early and take action will be in a far stronger position than those who continue to place blind faith in a failing fiat system. If history has taught us anything, it's that wealth is never destroyed, it merely transfers. The question is, will you be on the right side of that transfer?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.